Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Trump calls for the immediate evacuation of Tehran. That comes hours after urging Iran to sign a deal to limit its nuclear program, and Israel signaled strikes would continue. As Trump leaves the G7 meeting early, the other leaders issue a joint statement urging a broader de-escalation of hostilities in the Middle East, including a ceasefire in Gaza. And Bank of Japan holds rates at 0.5%, but will trim bond purchases by 200 billion yen per quarter starting in April 2026. It has just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Another morning, geopolitics still front and center. It is a moving fast, very fast-moving news cycle over here in the region with the latest between Iran and Israel and the fact that President Trump has decided to leave the G7 meeting earlier than expected to deal with the situation in the Middle East. So how are markets reacting this morning? As you can see behind me, both the S&P and the Nasdaq futures are tilted towards the red, down about 0.3 respectively. Not a significant amount, but still does tell you that there's somewhat of a reaction to the latest and the fact that things continue to escalate between Iran and Israel over the course of the last 4 or 5 days. The USD not seeing so much of a bid today. We're trading sideways. Not a lot of movement, though we have seen in the past 24 hours money pour in to the safe haven alongside other safe havens, including the likes of gold, which is getting very close back to all-time record highs once again. And then Brent, you can see this morning up once again, up about 0.5%. This as well after President Trump put out a tweet or a post, I should say, on Truth Social calling for the full evacuation of Tehran. So not really mincing his words there. On the back of that, we did see a bit of movement in the price of oil. And speaking of oil, just want to show our terminal chart today, which is telling you how much upside volatility has been priced in to the options market for oil. And you can see that implied vol on Brent is the highest level it's been since 2022. And of course, back in 2022, that was when the Russian invasion of Ukraine kicked off. So we are at implied volatility levels not seen in 3 years in the energy complex. Okay, we're also keeping track of central bank decisions this week, a major week for central banks, but Bank of Japan are really kicking things off. We just got the meeting out of the Bank of Japan. No surprise, really, on the interest rate decision, Avril. But how are some of these Japanese assets reacting, particularly because they have announced that they're going to be trimming bond purchases from April 2026?
Yeah, Jumana, I mean, as you know, the job of central banks, including Japan's, has gotten very complicated of late because of the bond market ructions, I should say, as well as what we're seeing in the oil price spikes and the worries about cost-push inflation. So today, the BOJ decision, it left rates unchanged. This was as expected, but the concern was actually more about how it would slow the pace of tapering. And indeed, this was it acted according to what markets as expected, and it will slow the pace from April of next year. Now, the problem was that there was actually a hawkish holdout. It wasn't a unanimous decision. So JGBs will likely remain on offer, and we are seeing already JGB futures sliding. In terms of dollar yen, we didn't get much support from the BOJ, so the focus will shift to Ueda's presser later today. Joanna.
As always, Avril Hong, thank you so much. That was Avril in Singapore. Now, President Donald Trump will depart the Group of 7 Leaders Summit, the G7 Leaders Summit in Canada, a day early. It comes hours after he took to social media to call for the evacuation of Iran's capital, Tehran.
President, any statement on why you're leaving the G7 early for Washington?
Well, I have to be back. Very important.
For more, let's bring in Bloomberg correspondent David Gura, who is inbound for the G7 meeting. I know it's late over there, David. Good to have you with us on the show. It's no surprise, really, that the developments in the Middle East have eclipsed this G7 summit. Perhaps what was a bit of a surprise is the fact that President Trump has decided to cut it short and is leaving one day early. What do we know about this decision and the statement that has just come through from the G7 vis-a-vis the latest developments in the Middle East?
So you're absolutely right that this cast a long shadow over these meetings, and it wasn't part of the official agenda, but it was something that was talked about an awful lot as world leaders made their way to Canada and on the sidelines of the meetings today as well. And there was this hope throughout the day that all of these world leaders would be able to come together and issue a statement on this conflict in the Middle East, effectively telling Iran and Israel to de-escalate that conflict. And for most of the day, it seemed like the United States was not going to be a signatory to that particular statement. President Trump said he didn't want to. He began to talk more and more about diplomacy is the only track forward here. We know that before he left, before he had dinner with everyone gathered here, all of the G7 leaders posed for that family photograph that's part of all of these gatherings, he did sign on to that document. And in it, they affirm that Israel has a right to defend itself. The group reiterated its support for the security of Israel, called out Iran for being a source of terror, said it should never have a nuclear weapon, and then, quote, urged the resolution of the Iranian crisis that leads to a broader de-escalation of hostilities in the Middle East, including a ceasefire in Gaza. That last clause, something that the Europeans were really pushing for over the course of the summit thus far. And there's also a nod into that statement, if you'll allow me to read just a bit more here, to market volatility. We will remain vigilant to the implications for international energy markets and stand ready to coordinate, including with like-minded partners, to safeguard market stability. To the second part of your question, why this happened, why the president decided to leave, the official line from the White House is he needed to get back to Washington to deal with this crisis. And that, of course, Jumana, opens up this broader question of what does that mean? Are we going to see the U.S. administration, the Trump administration, becoming more involved militarily in this conflict, or is it going to be something the likes of which we heard from President Emmanuel Macron, who speculated kind of optimistically that the U.S. could play a role here as a peacemaker, could call for a temporary pause in hostilities, get some ceasefire in place. We'll see what happens. The president isn't due back in Washington until very early in the morning at Washington time.
Yeah, absolutely. And to your point, David, it could go in either direction at this point. But the hope from the market and of course, the international community is that there is going to be a push from the U.S. side to restart those diplomatic channels. Let's just go back to the G7 because ostensibly many of the talks that were scheduled to take place were going to be around trade and these so-called trade deals that the U.S. administration has been pushing for. Has there been any success on that front?
Yeah, that was the hope certainly on the U.S. part going into these talks before that conflict in the Middle East escalated. And of course, at a summit like this, there are so many opportunities for each of these nations to talk on the sidelines, have these bilateral meetings. Some of that has taken place here. There weren't a whole lot of bilateral meetings involving the U.S. president, but there were some. And we saw the U.S. and the United Kingdom codify this deal that was announced a few weeks back in the Oval Office in Washington, D.C. Not a hugely comprehensive trade deal, but one that the White House holds up as a sign of progress in sort of rewriting the rules of trade between the U.S. and a close ally. Yes, the hope was we'd see more of that. The president did sit down with the Prime Minister of Japan, who was very outspoken about the fact that he wanted to have that audience with President Trump, wanted to talk about trade. And somewhat disappointingly to the Japanese, there was no agreement reached. There's talk of there being continued progress in those talks. But that deal between the U.S. and the U.K., which for so many weeks has been the only thing the White House has been able to hold up as a trade deal since the president announced that trade war now a couple of months ago, is really the only one that we have yet. So it was signed by the Prime Minister and the President, but nothing beyond that yet. And now with President Trump gone, unlikely that we'll see anything more here. We did hear some good rhetoric from the Canadians that they're hoping over the next 30 days they'll be able to reach some sort of agreement, but nothing more concrete than that.
Bloomberg correspondent David Gora in Banff, Alberta, Canada. Great to have you with us on the show. Thank you for the overview. Now, Israel is vowing to pursue its military operations against Iran, regardless of the progress of any potential negotiations involving the U.S. Ron Dermer, Israel's Minister for Strategic Affairs, told Bloomberg Television Israel will continue to act until it eliminates Iran's missile and nuclear programs.
We're going to go about our operation to remove these two threats. Whether Iran will decide to meet with the United States and agree to terms that they should have taken a month ago or 2 weeks ago or 2 months ago, that's up to Iran to decide.
Joining us now is Shibley Telhami, Anwar Sadat Professor for Peace and Development at the University of Maryland, College Park, and non-resident Senior Fellow at the Brookings Institute for Middle East Policy. Really good to have you with us on the show. Look, two developments have happened over the course of this morning. The first is that President Trump decided to leave the G7 summit early. presumably to focus on the events that are taking place in the Middle East between Iran and Israel. But simultaneously, he also put out a post on Truth Social warning Tehran residents to evacuate. How do you dovetail the two and a real push from the international community to restart the diplomatic channels, but at the same time, President Trump warning Iranian residents to leave their homes in the capital?
Yes, it was surprising. Yeah, I was surprised by it. It's definitely echoing the Israeli call for Tehran residents to evacuate. And it's really peculiar to take that posture, which is essentially echoing the demand of Israel at a time when you're also saying you're going to negotiate a deal, you're going to mediate between the two parties. I cannot tell you that I have a full understanding of how our president operates. And I say that as someone who studied him. I have a book forthcoming with some colleagues addressing his first administration, and we've had lots of interviews with people who work with him closely, his top advisors who gave us interviews. And, you know, he's really an unpredictable man. He doesn't follow the issues very carefully. He takes positions impulsively, and then everybody has to adjust. He doesn't always consult. So what he meant by this is really hard to know. The best I could tell is that he thinks of himself as using this as pressure to maybe still make a deal. The problem that I always had, I don't think he had intended from the beginning to be drawn into a war. He understood, I think, that the Israelis were trying to draw him into a war, but I think he put himself on a slippery slope, particularly making demands that the Iranians could meet, and I fear that he's doing the same now.
So my colleague spoke to Ron Darmer yesterday, and he was saying that Israel is still pursuing twin goals to eliminate Iran's nuclear and missile capabilities. The National Security Advisor for the Israeli government also gave an interview yesterday to the Israeli army where he said that he still thinks that Iran are sitting on thousands of ballistic missiles. We also know that many of the uranium enrichment facilities are deeply embedded, particularly in the Fordo nuclear enrichment sites. Therefore, it's going to be difficult for Israel to achieve those two aims in a quick fashion. What is the likelihood that this becomes yet another Gaza situation and a war that just goes on indefinitely in order to achieve those two aims?
Put aside what Israeli officials do. Of course, I'm not an official, I'm an analyst, and they can say what they want, and they have to say what they want. This is part of their foreign policy. But the truth of the matter is this war was unnecessary. It could have been avoided. A deal could have been made. There was a deal already that Obama administration had negotiated, that the rest of Europe accepted, the rest of the world accepted, from which President Trump withdrew during his first administration. They could have had another deal similar to that. And obviously, this war happened just a couple of days before there was a planned meeting between the American negotiators and the Iranian negotiators. So this was an unnecessary, unfortunate, ruinous war. So put that aside. Now we're in it. And yes, you're right. I think that the Israelis obviously have very, very great capabilities supplied by the U.S. They're using the top American weapons that practically no one else other than Israel and the U.S. and NATO have. So they have excellent capabilities, but they cannot finish a war because, number one, they cannot end Iran's nuclear capabilities. They can damage it, but they can't end it. And number two, they can't end the weapons program of Iran. And so then what? What do they do? Even if they were to destroy what Iran has, what do they do then? So I think the third aim they have, which has already been stated, and you didn't mention, obviously the officials didn't mention, is regime change. This has been something that Prime Minister Netanyahu has wanted to do for years, not just recently. And now it's become more pressing for them because they didn't see a win in some ways that they could sell to the public without that. And the U.S. has been not favoring, including President Trump. President Trump has said he doesn't want to, regime change and nation building. But I think now it's become a real possibility of trying to do just that.
Shibley, really good to have you on, and looking forward to speaking to you in the coming weeks and months as things evolve. Shibley Telhami, Anwar Sadat Professor for Peace and Development at the University of Maryland, College Park, and non-resident senior fellow at the Brookings Institution Center for Middle East Policy. Thank you. Now, still ahead, Deutsche Bank says rising geopolitical tensions have taken center stage for global markets as rising tensions between Iran and Israel show no signs of abating. More on their market strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Global markets fluctuated as investors weighed the Israel-Iran situation after President Donald Trump called for the evacuation of Tehran. Joining us is Deepak Puri, America's CIO at Deutsche Bank Wealth Management. Let me just start off asking you, what is the level of concern of the clients that you speak to around the developments in the Middle East right now?
Well, they're heightened for the time being, and that's not out of the ordinary, right? You're looking at a region that is the source for so much of the crude energy that flows through the rest of the world.
Yeah.
So I think the transmission mechanism everyone is concerned about is the price of oil, because that's really how the geopolitical situation sort of transmits itself to the broader markets.
We had a bit of a bumpy ride for equity markets around April, that month, April to May.
Sure.
Fully recovered now. S&P is up 2.5% for the year. What are people saying about the outlook for risky assets? What could dent this recovery that we've seen?
Quite a few things in the near term. I think the recoveries, because I think the sell-off was a little bit out of the ordinary, right? The sell-off in April was a little bit because you're looking at the most aggressive tariff regime that was going to take into place. And as we see, President Trump started to renege or pause some of those agreements, and market took a sigh of relief that it's not going to be as severe as what initially anticipated. I think now the market has too many narratives that it needs to build a consensus on. The first is with regards to the Fed. We're going to have a Fed meeting tomorrow, so we're going to get more insight there. But also the size of the reconciliation bill. I think from a U.S. perspective, it makes a big input in terms of what is the size and scope of this bill. The third thing would be the deregulation aspect. We haven't really seen that kick into the market psyche yet. That could really propel the market, but that's, I think, is a second half of the year story, not really the next couple of months. So next couple of months, I think the geopolitical and the fact that we had such strong may hover upon the market sentiment before the market gets ready for another takeoff.
What about July 9th? What happens on July 9th? That's when the 90-day pause comes to an end on tariffs. Are investors being too complacent about the possibility of these tariffs going up again?
I think we know how high they are going to go now. So the level of uncertainty is not there as it was on April 2nd, right? We know what the worst-case scenario is. So you can sort of model that in your market outlook. I also believe that from now till July 9th, it's not too many days left, but you are going to see some bilateral trade agreements being reached. And last but not the least, as President Trump has shown, he can easily put a pause or put another deadline on some of these.
The taco approach, as some people are calling it, I guess investors push him to that point, and they know that at some point they either back down or there's a deal reached. Let's just talk about the reconciliation package. Sure. From an equity standpoint, are you expecting any tailwinds to corporates on back of some of the corporate provisions, say on capex, on R&D, on interest rate deductions? I mean, could those provide somewhat of a tailwind to equities at the end of this year?
Absolutely, and you're seeing it. Cash is. Corporate America is in a very good health. You can see that with the earnings season. You can see it with how much cash they're carrying. You can see it from guidance they're giving. Yes, some of the companies are not really upfront with it. But if you look at the spreads, let's see on the corporate IG side, you see it's fairly tight. And that tells you that the economy is okay and the corporate health is okay. I think some of these things that you mentioned might play a bigger role, along with the buybacks, which has been a common feature of this market for quite some time. So I think along with the depreciation probably is the number one, and some of the regulatory relief, both on the banking and telecom and tech side, these things might play a big role.
Is it fair to say then that in the second half of the year you think that fiscal policy will move back to being in the driving seat for equity markets?
At least that's what the markets are hoping for.
Right.
As of today, you expect that the summer months are going to be a little bit tricky because we still haven't realized the base case for what the cost of tariff is going to be for the market. And that cost is higher inflation and lower growth. Once that is established, I think the next moving point is going to be the fiscal.
Do your clients believe U.S. exceptionalism is back on the table again?
I think it never went away, frankly speaking. I think we had such strong flows for 2022, 2024. A little bit of a rebalancing was in the order, and that's exactly what we saw.
Final question, because I always think this is interesting to see where individuals and retail accounts are positioned right now. What would you say is the most overcrowded trades that people have on?
I think most Americans, they love the home bias, just like we all do. And within the home bias, there's a lot of push for big tech, which again has done reasonably well. But when I look at clients' portfolio, I do try to talk about some other parts of the markets, both within the U.S. and outside, because I think it's a good time to look in elsewhere. European equities have a nice bid, some nice prospects, and so also in the Asia side.
Yeah, really good to speak to you, Deepak. Thank you so much for coming on our show. Enjoy the rest of your time here.
Thank you.
Deepak Puri, America's CIO at Deutsche Bank Wealth Management. And coming up, Israel's economy faces mounting challenges after more than 20 months of war in Gaza and an escalating conflict with Iran. We'll hear from the chief economist at Israel's Ministry of Finance later in the show. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Ukraine's capital Kyiv is facing another massive drone and missile attack. Air defense has been operating all over the city, but 12 civilians have been injured. That's as residential areas and private vehicles have also been damaged, and electricity supply has been interrupted in several districts. Israeli troops opened fire on Monday as crowds tried to reach Israeli and U.S.-supported food distribution centers in Gaza. AP reports that 34 people have been killed, according to health officials. That would make it the deadliest day of such shootings since the new aid system launched in May. The Israeli military didn't immediately comment on Monday's shootings. The Red Cross field hospital nearby received around 200 injured on Monday, the highest single mass casualty event it has seen, according to the International Committee of the Red Cross. And coming up, hear why Goldman Sachs expects no disruptions to oil supply in the Middle East, even as missile strikes continue between Israel and Iran. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. President Trump calls for the immediate evacuation of Tehran. That comes hours after urging Iran to sign a deal to limit its nuclear program, and Israel signaled strikes would continue. As Trump leaves the G7 meeting early, the other leaders issue a joint statement urging a broader de-escalation of hostilities in the Middle East, including a ceasefire in Gaza. And Bank of Japan holds rates at 0.5%, but will trim bond purchases by 200 billion yen per quarter starting in April 2026. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai, and we should be getting images soon of President Trump leaving that G7 summit in Alberta, Canada. So when that happens, we'll bring them to you live. But for the time being, let's go back and check on how these markets are faring. Yesterday, S&P and NASDAQ brushing off some of the concerns of the geopolitical risks in the region, ending the day up in the green. S&P futures, though, down 0.4% now. NASDAQ also down a similar amount. All eyes will be on retail sales today. And, of course, that Fed meeting that is set to take place tomorrow, will they sound less dovish than what the market is currently penciling in around around 50 basis points of cuts throughout the rest of this year. Does that get dialed back tomorrow? Big question for markets, given some of the upside risks to inflation coming through from oil. USD, not seeing a lot. It's trading sideways today. And then Brent, once again in focus. We're going to talk more about the energy complex shortly with Anthony DePaula. But this is where we are right now, just shy of $74, another 0.5% firmer on the session. This as well after President Trump tweeted that the residents of Tehran need to be evacuated. Take a look at this terminal chart. This is implied volatility in Brent. It is at the highest level since 2022. So options markets, vol markets are once again accounting for a lot of volatility in the energy complex. All right, let's check in on how markets in Asia are faring as well. Avril Hong is in our Singapore studio. Run us through what you're looking at. And of course, Bank of Japan, one of the major movers in the last couple of hours. Avril.
Yeah, the Bank of Japan decision was more or less as expected. It kept rates unchanged. The bigger story was behind its plan to slow taper, and indeed it acted as markets had anticipated. It will start slowing the pace of taper from April of next year. But the issue, as I mentioned in our previous conversation, was about how this was not a unanimous decision. There was one hawkish holdout, so JGBs will likely remain on offer. Now, we have seen the Japanese yen in the past 30 minutes or so. That climb has been gaining a bit more steam. We will see if Ueda's comments later provide a bit more fuel for the Japanese currency, but we're seeing dollar yen now hovering at the 145.5 handle. Jumana.
Avril, thank you so much. Avril Hong in Singapore. Now, oil jumps higher this morning after U.S. President Trump calls for the evacuation of Tehran. That's as fears rise of an escalation in the Israel-Iran conflict, which could disrupt crude supply. So far, Iran's crude exporting infrastructure has been spared, and there are no signs that Tehran is seeking to escalate hostilities by disrupting flows through the Strait of Hormuz. For more on this, we're joined by Anthony DePaula, our Middle East energy reporter. It is very tricky to sort of weed through all of the headlines that are coming through, but for the most part, we have seen oil move dramatically higher on Friday. Yesterday, there was a bit of a relief, I guess, because things didn't escalate even further as far as energy infrastructure is concerned. How much geopolitical premium do you think is actually priced in to where Brent is trading right now, Anthony?
Yeah, I mean, I think this movement in the oil price is all geopolitical premium. So as you see it going up and down, that is going to be what it is. So where we started before this was we were looking at prices around the 60, 65 realm. So, we're talking about roughly $10 higher than where we were kind of last week going into this. Now, we have seen that movement going up and down, and I think we are going to continue to see that volatility as the market reacts to headlines. As a headline comes out, they're very reactive to the geopolitical issues as the market and traders then look and see what the actual implications are for supply and for the oil price. So we haven't seen that come through yet. So at pricing, where we are now around $74, I think when I spoke on television yesterday, it was around 75. We're not at interruption levels yet. So traders are not concerned about the interruption of supply. We're just kind of reacting on those headlines. We did see that big move higher at the start of trading yesterday on those headlines from the weekend that the first strikes were starting to hit some energy infrastructure. However, that hasn't been the key production or exporting infrastructure that Iran needs.
People have been talking about the Trump pump. That expression, I've been reading it a lot in comments over the last couple of days, because what OPEC did was bring forward the supply, the production to the market in a way that actually surprised market participants. And now people are saying that if they hadn't done that, then oil prices would be trading a lot higher than where they are right now. Do you think there is perhaps somewhat of a political element to the OPEC Plus decision-making that took place in the run-up to these events?
I mean, of course, when you're talking about governments getting together and deciding on these big issues, there is some element of politics in that. So OPEC will tell you that they're looking very much at the fundamentals of the market, but they are a group of governments that come together. So even between OPEC and themselves, there's a lot of politics in terms of keeping the group together. So that decision was based a lot on politics around keeping the group together, because countries like the UAE, which have a lot of spare capacity and have invested a lot of money in that spare capacity, want to get that oil to the market. So we saw this even as long as a year ago when OPEC Plus decided to start putting in place this plan to increase barrels. That was a political issue to keep cohesion. And now we're seeing it. OPEC is saying that this round was caused because they saw lower stockpiles, because the market could take it. Well, what we were looking at up until last week was the market could take it until about the first half, and then we were going to very weaken. Now we've got this geopolitical concern in there. So those barrels are helping, but OPEC still has a lot of spare capacity that they could still bring on. Of course, they're not going to be complaining about the higher price. Trump might be, but this is out of anybody's control right now as we react to these headlines. And if the conflict does escalate, then things could go even higher if, and that's a big if those supply is impacted and production and export facilities are hit.
Yeah, Anthony, well, let's continue the conversation. It was Anthony DePaula, our Middle East energy reporter. Joining us now is Nikhil Bhandari, the co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Nikhil, I'm sure you heard Anthony sort of just give an overview. I'm going to actually put the same question to you because I'm curious to hear how Goldman are thinking about the upside risk to the Brent and to energy complex based on the geopolitical developments in the region, and just how much premium you think is priced into the curve here.
Yeah, thank you. Thank you for having me on the show. Look, it's a complex moment for the oil market. On one hand, when you look at the markets in the near term, inventories are not very high, demand is seasonally rising, and the geopolitical premiums have risen. As it was mentioned in the prior discussion, the rally in oil price from 60 to 65 range towards now around Brent 74 is mostly on account of the building geopolitical risk premium. However, when you, if assuming there is no physical impact on the infrastructure for oil, and we look forward 6 months out, we're still looking for a surplus building up in the oil market. We do have non-OPEC supply growth rising. That is the long cycle project completing in Guyana, Brazil, and Canada. And at the same time, we have OPEC releasing more barrels. We're expecting another release in the month of August. So again, from an oil market perspective, without any physical disruption, we are expecting Brent back to $60 by the end of the year. Now, in terms of scenarios, if there is a physical disruption to Iran crude, and let's say we assume that half of that is offset by OPEC releasing even more barrels into the market. Now, if you look at the historical context, when we had such large disruption, we have seen OPEC offsetting that impact by up to 80% within 2 quarters. But let's say the OPEC strategy is a little unclear at this point. But even if you assume it's a 50% impact being offset, then oil prices could head towards a little over $90 in that scenario.
Let me ask you about the demand side of things, because you articulated the extra supply that's to come from non-OPEC producers. What about demand? And the reason I ask this is because equity markets seem to have recovered. There's a lot more optimism in other risky assets. Is that being adequately reflected in terms of how you're thinking about demand panning out the rest of this year?
Sure. So, look, in a normal GDP growth year, oil demand grows about 1 to 1.5 million barrels per day. We think oil demand growth is going to be about 0.6 to 0.7 million barrels per day growth this year. We have to admit the demand growth has been better than feared so far. We have had strong prints of demand in the U.S. year to date. We've had pretty strong print for the core products like diesel, gasoline, and jet fuel in markets like India. And overall, oil demand growth has been stronger than feared. I would say when you look at the latest print of the May jobs data point from the U.S., all of that is still pointing towards a bit of slower economic growth, but not a recessionary demand setup yet. So again, we are in a camp of slower economic growth environment, looking at 0.6 to 0.7 million barrel per day of oil demand growth, accelerating back to about 1 million barrel per day growth next year. But against that, when we look at the context of supply, non-OPEC ex-US supply growth between this and next year can be close to 2 million barrels per day. That alone offsets the oil demand growth between this and next year. So OPEC releasing barrels on top becomes more bearish. And that is why, without any physical disruption to the infrastructure for crude, we are looking at 60 Brent by the end of the year and 56 Brent by the end of next year.
And yet, I see that Goldman have put out a note on the outlook for refineries, and you and your colleagues are saying that the setup there echoes the 2015 to 2017 upcycle. Why are you bullish on the outlook for refineries then?
Sure. Look, refining story is looking different than crude. On one hand, inventories are tight. When you look at diesel and gasoline inventories, they are fairly at the low end of the last 5-year range. At a global observable level. However, structurally, refining is more tighter. If you look at post-COVID, we have roughly seen about 5% of global refining capacity closing permanently, while oil demand growth is 3% roughly higher than the pre-COVID level. So there is no slack or spare capacity left in the system. In fact, this and next year, we are again seeing net refining capacity add in the system as pretty muted. We do have some gross addition, but every quarter from start of this year until mid of next year, almost every quarter, we have one refinery permanently closing. So the net capacity addition is, again, negligible this and next year on top of very low spare capacity. So for oil market, a decent level of oil demand growth is not enough given the surplus we are talking about from a non-OPEC and the OPEC plus barrels coming in the market. But in the case of refining, given the supply side is so tight, even modest oil demand growth in a slower economic growth environment should be enough to tighten the refining market. Again, back to your point about the setup like 2015 to 17, what we saw in 2015 to 17 is a more supply of crude environment. OPEC releasing barrel, looking for market share. We had non-OPEC supply growth. That's a good environment for refiners because as a refiner, you want more supply of crude, of your feedstock, so we don't have to overpay for that. And at the same time, refining supply demand was tight back then. The only difference is back in 15 to 17, it was more demand-led tightness in the supply demand. This time around, it is more closures and supply delays led tightness. So again, both the crude and the refining supply demand equation is looking more constructive for refining.
Great to have you with us on the show today. Thank you for your perspectives. Nikhil Bhandari, co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Coming up, Israel's mounting war costs weigh on the country's budget as the conflict with Iran shows no sign of ending. We hear from the chief economist at Israel's Ministry of Finance next. This is Bloomberg. Israel's war costs continue to climb as the country's conflict with Iran enters its 5th day, while the war in Gaza drags on after more than 20 months. Joining us now to discuss the impact of the wars on Israel's economy is Shmuel Abramzon, chief economist at Israel's Ministry of Finance. Good morning to you. Let me start out by just asking you about the state of the economy, because Israel has been at a state of war for over 20 months now. And even before this latest front opened up in Iran, there was a budgetary overrun of about 1 percentage point. To what extent do you think that we are going to continue to see mounting costs as a function of the war that has been going on, and in addition to the new costs that will be associated with the front that has just opened up in Iran?
So thank you. Good morning. As you said, we've been experiencing more than 20 months of geopolitical tensions and substantial military expenditures and needs. Looking forward, it's hard to say at this point, but our baseline scenario is actually very, very positive, and we believe this is a matter of not very long for it to end. Therefore, we don't expect very substantial future costs for this situation.
Let me just repeat those comments to you. So your expectation is that the war in Iran will not go on for a long period of time then?
This is our baseline scenario. I think as we look at the news and the way things are unfolding, and I think there's very, very good reasons to believe that it's a matter of weeks and not many weeks.
Have you updated your forecast for the costs associated with the multiple wars and conflicts that Israel are engaged with right now? And you've got indirect costs as a function of the economy having to shut down and airspace closed, but then you've got the direct costs as well associated with actually purchasing munition and ammunition.
Right. There's definitely several costs. So you mentioned the 20 months. So if we look at the whole very, very wide event, we're talking about between 13% of GDP to 15% of GDP over 20 months. When we're looking specifically at this Iran-Israel situation, we're talking about roughly, I would say, at the higher levels, at roughly 0.5% of GDP. As you can imagine, you can understand in the long run, these are not very, very substantial costs for an economy. Israel has all the ability to absorb these costs. We have been very, very successful in financing our needs. We have a very strong financial base, very, very high demand for lending. Just yesterday, we had a very good, smooth bond issuance of Israel, and markets show very, very high levels of trust in our finances.
What are your plans to ultimately bring down debt to GDP? Because the number shot up obviously to 68% last year from 60%. Are you even thinking that far ahead? Are there going to be plans for fiscal consolidation, or is it too early to think about that now?
Absolutely. And one of Israel's strengths and our ability to really weather these challenges is our fiscal discipline. It's a very, very strong anchor for Israel's policy for more than 20 years. And our base plan for this year was to stabilize that debt to GDP at around 70%. This might change a bit because the last needs because of the Iran escalation, but it's very, very likely that debt to GDP will be stabilized soon, and 1-2 years ahead already starting to lower itself.
Can I also just ask you about the number of soldiers that are serving right now in Gaza, about 50,000, that obviously is having a detrimental impact on the economy. At what point does it actually make sense for those soldiers to return back to the workforce, to provide productive capabilities to the economy, as opposed to being deployed and a big focus on the security situation at the expense of the economy?
So, of course, the deployment of soldiers, reservists, has an effect on the economy. And I'm not sure I understood the question. Of course, as economists, we prefer them to be home, to be productive, and not engage in this war. And we hope this will end sooner than later, so they can come back, and it's very, very clear from our perspective.
Yeah, fair. Let me just ask you another perspective as well. In the last few weeks, we've been reporting on the fact that especially countries from Europe may look to reevaluate some of the relationships or even trading relationships that they have with Israel on back of the ongoing war in Gaza and frustration with how it's being handled. Are you expecting that to have knock-on effects to the Israeli economy as some of the relationships with your partners in the West come under strain?
Yes, of course, we're not happy about any of these statements, and we don't take them lightly. However, I believe that given the optimistic forecast for the situation, and we believe there's going to be a cessation of these events fairly soon, but I believe that also these statements and these relations will go back. At this moment, it's merely statements, and we're sure and hoping that things will get back soon, well, very, 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 very soon. I will say there's also huge upside for our future, and knowing that the security situation is going to be much better, and there's a lot of signs of optimism, and hopefully this whole war will end soon. The opportunities are huge with all our trade partners and new trade partners, including in the region. So we keep very, very optimistic.
Shmuel Abramzon, Chief Economist at Israel's Ministry of Finance, thank you very much for joining our show today. Now, prices for cocoa on the global market have nearly tripled since 2023 as bad weather and disease outbreaks exacerbate supply issues. But farmers in Ivory Coast have found it hard to cash in as the government-run regulator sets the price at about a third of the global level, fueling smuggling of the crop to neighboring countries. For more, Bloomberg's Ondiro Ganga joins us now from Kigali, Rwanda. Ondiro, talk to us about the incentive to smuggle cocoa and how smugglers actually get it out of the Ivory Coast, looking obviously to take advantage of these higher cocoa prices now.
Jumana, smuggling is a dangerous but highly lucrative business. Now, when you're caught, you face up to 10 years in prison or pay a fine of up to $86,000. But on the flip side, if you're not caught, you can make up to $240 a week in comparison to $80, which is a monthly living wage in the country. So that is incentive enough. You also look at the prices of cocoa in the international market. They've nearly tripled. They peaked at $13,000. Now they've settled at $9,000. And in the intro, you mentioned that there are a couple of other factors that are fueling shortage, bad weather, diseases, underinvestment in the industry. And all these are factors that are just leading to price gains in the international market. And as a result, we are seeing prices soar, but farmers are not feeling the gains because most of their beans are bought by government-run institutions. And this is because the government is trying to insulate farmers from volatility in the international market. Now, when the prices are low, the farmers enjoy the cushion. But when the prices are high, they can't help but feel shortchanged, particularly when countries like Togo, Liberia, and Guinea are offering to pay nearly twice what the government is paying in Cote d'Ivoire to buy just a ton or a bag of the beans. And so we are seeing smuggling on the rise, motorbikes and trucks taking alternative routes in the night, trying to smuggle cocoa out of Ivory Coast into neighboring countries like Guinea. And as a result, despite Guinea not making enough investment to boost domestic cocoa production, their shipments have grown by 15%. And while they're reaping the benefits, the pain is being felt across the border.
And Ondiro, how is the smuggling actually impacting the economy both in Ivory Coast, but also just more broadly in the region as well? What sort of an impact is it having?
Jumana, it's unfolding quite fast. In 2023-2024, shipments of cocoa at the port dropped by over 30%. And while there are other factors contributing to this, the government says over 100,000 tons were smuggled out of the country in comparison to 1.7 million tons that they produced in that season. And because cocoa accounts for up to 40% of total export revenue for the government, this could leave a big dent in their national budget and also their development plans in the country. Other people who are also feeling the pain are international buyers. Sourcing has become more difficult because, one, there's shortage, and two, you cannot trace the beans, particularly now that EU regulations are going to come into effect on the 30th of December. If you cannot trace the beans, then you're unable to rule out deforestation and child labor from the value chain, and that means that it will be harder for these beans to be absorbed in the international market. Exporters and traders are also feeling the pinch because when there's a shortage, then they're torn between either breaking the law or paying exorbitant prices at farm gate to be able to get their hands on these coffee beans, and that means cocoa beans rather, and that means that these prices are being passed down to the consumers. A cup of chocolate is higher, and also a bar of chocolate, prices are going higher and higher.
Yeah. Not good for my personal expenditures. Bloomberg's Ondiro Ganga in Kigali, Rwanda. Thank you so much. A quick look at equity futures. Things are actually leaning towards the green despite heightened geopolitical risk in this part of the world. That is it for Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.